Welcome to the CFA Institute Research Foundation's Financial Thought Exchange, where we exchange financial thoughts with the greats and the not-so-greats of the financial world. And today's guest is the very great Cliff Asness, who founded AQR Capital Management about 30 years ago.
26.
27. And time flies, and it has become fabulously successful, extremely well known. And during that period of time, Cliff has also published massive amounts of research with his many colleagues at AQR. We're going to talk about that today. But first, let's start with your origin story, Cliff. It's become a cliche, but we all have one. And I believe that you went to that mysterious institution on the south side of Chicago, where I also went, the University of Chicago. What would you like to say about that period in your life, and can you bring it up to the founding of AQR, if you like it?
That's I like origin story. As a comic book fan, I like the idea of an origin story. I was bitten by a radioactive Fama back in the late 80s. That's a Spider-Man reference, Larry. I'm not sure you're up on comic books.
I am not, but our audience may be evenly divided here. Either a radioactive Fama will resonate with somebody, or they're going to say, "What in the actual hell did he say?"
That's okay. Why don't
you? Yeah, why don't you?
It's not fun if they get all the references.
Right.
I ended up at the University of Chicago. I'll go back even a drop further.
Great.
Kind of junior, senior year of college, I had still intended to apply to law school. My extended family were like all lawyers of different stripes. I just grew up assuming my dad was an assistant district attorney in Manhattan. I kind of assumed that. And at some point late in my college career, my father said something very close to, "Why are you going to be a lawyer? You're good at math. We're not." And my mother was good at math, but my father wasn't. I had been doing some work for finance professors. My undergrad, one of my degrees was computer science. So I took a programming job just for money for 3 professors, one of which turned out to be Andy Lowe. I guess he was Andy Lowe back then also, but he wasn't quite Andy Lowe.
Oh, now he's Andy Lowe.
Now he's Andy Lowe. I was coding up their studies, and I just found it pretty interesting. And I said to some subset of them, if I want to do what you guys do, what do I do? And they looked at me like I was a little slow-witted, and like, well, you get a PhD. Have you noticed we all have PhDs? And then I went. I was not a big barge into professors' offices guy. In college, I mainly sat in the back and just took my notes. But I actually got off my butt and I went to maybe 10 different professors and said, "Where should I go?" And 9 of them told me the University of Chicago. Nothing bad about Wharton.
Where were you at the time?
I was an undergrad at Wharton. Sorry, I didn't mention that. That's important.
No,
And I guess I had assumed PhD programs just lined up with MBA programs, and they don't.
Nope.
Sometimes they do, but they don't. And I have no idea. I've not kept up on this for the last 40 years. Maybe Wharton's great, but at that point, Chicago was very dominant. And 9 of the 10 professors, most of which had gone to Chicago, so they had a little bit of a bias, but not all of them, said, "You want to go to the University of Chicago." One, Bob Litzenberger, said, "Go to Stanford." And he was an ex-Stanford professor. And there was a little bit of a, and this is probably muddled now too, but there was a little bit of a, go to Stanford if you want to do theory, go to Chicago if you want to do empirics back then, which was never, it was never a perfect line. You could do either at either, but, all else equal. And, I decided that weather in California wasn't for me. I really wanted Chicago winters, just to...
It gets you to go to class and then study. California is too much fun.
Well, this is actually funny. Chicago offered, after accepting me, Chicago offered to pay for me to visit. I mean, pay like a coach ticket and a motel room kind of pay.
Yeah, that's
And I asked Stanford, I had no money, but I asked Stanford, would you guys pay for this? And they're like, it's not in the budget. So I only visited Chicago, and I visited it on a beautiful spring day. And I'm fond of saying, which I hope is not literally true, that I'm the only one ever to choose Chicago over Stanford on the weather.
for the
There was
weather.
a little bit of a bait and switch occurred. But I did choose to go to Chicago. Then, you got to acknowledge the role of luck in your life,
Yes.
particularly if your life turns out in some way that you're happy with. You probably got lucky
Oh, yeah.
along the way. Not, it is grand luck. What age and country were you born in? Your parents, your genetic lottery.
Right.
But there's a lot of other just path-dependent luck.
Mhm.
And I showed up at Chicago in 1988 when Fama and French, and they were not the only people doing this kind of research. I could be Chicago biased and give them all of the credit. Think they get a lot of credit. But they were doing the research that became, we didn't use this phrase back then, but became the underlying parts of what we call factor investing now. It is funny, when you look at the past, you, of course, tend to use the terminology of the present, forgetting that you weren't calling it back then. It was just we sorted stocks on book to market, and we found this effect. It was not factor investing. I don't even think that was called value investing early. I think that label, which we can get into, but I think that was a bad label. But that got added later on. But I ended up writing
a little older, Jim. We called it finding anomalies in the cap app.
Yeah.
And nobody used the word factor in the 70s.
That was probably mid-90s. People started using that, and I'm guessing from memory. I'm really bad at dates. As I get older, I'm fond of saying I remember two periods well: the prior 2 weeks and high school.
Funny.
Everything else in between is like, that was like 5 years ago or 20 years ago. But I was there when this was going on. I ended up writing my dissertation for Gene and Ken on adding momentum to their factors, essentially. When you wanted to say, sorry, go on.
Didn't you and Eugene Fama have an interesting discussion about whether you should research momentum? As I remember you telling the story, it's worth retelling.
Yeah, okay. Essentially walking into, I had already done some of the work. I had already found that momentum had some efficacy that surprised me. I was not the first to do this. I think Jagadish and Tipman deserve pride in place for this. I think I was pretty contemporaneous with them. I think if I was a professor instead of a lowly grad student, I might have given them a run for their money. But they are the correctly acknowledged academic discoverers. I always say academic discoverers. Just because we found this in academia doesn't mean someone in the Roman Empire wasn't trading on 1 year price momentum. So when you say discovered, it was discovered for this. Documented it. And I do think we did it with a level of rigor that was never done before. But
you push against it,
but
and it moves the other way.
Yeah, and it's not a trivial thing. Sometimes there are things people do forever that actually don't work when you study them with rigor.
Yeah,
but going to Gene Fama's office and saying, I want to write a dissertation that largely, not entirely, focuses on the 1 year momentum strategy. And then I distinctly remember mumbling the second part, and it works very well. And Gene was like, what was that? And because that's not a very Gene Fama finding.
Not at all.
Right? And it's actually quite a warm story, because when I said, and it works very well, Gene, he paused for, 8 seconds and just goes, if it's in the data, write the paper, which is the closest thing I've heard from him to a religious statement. If it's in the data, write the paper. And over the year, he was very supportive of my dissertation. I think it would be fair to say he wishes momentum didn't work. He has called it numerous times in a very nice way, the chief blow to their 3 and then their 5 factor model. But he also is wise about it. He goes, no theory is perfect. It's a theory approximates reality. And this is one dimension it doesn't capture. So he was quite good about it. But when you're young and you're a naive student, you don't trust that he will be quite good about it. You are thinking, I'm telling Eugene Fama I want to write a dissertation that is at least a mild blow to the efficient market hypothesis. He's going to kick me out on my butt. And he did not.
Like telling Einstein, Dr. Einstein, I love your work, but you're slightly wrong in this one little area.
Actually, it's really great stuff, but time is absolute, Albert.
Al.
Al, even better. So I did feel like that, but it actually worked very nicely, and I give Gene all the credit for that.
Oh, that's a wonderful story. So let's move forward to what you did after you got your PhD.
How did I end up on the dark side?
Yeah. When you sold your soul, Jim Laurie, I think you knew him, said if
only a little.
You can only sell it once, so get a good price. So
they used to tell us this at Goldman Sachs to scare us from leaving Goldman Sachs. Even before I tried to leave Goldman Sachs, the saying, which I guess a lot of firms might use, is a very arrogant one. You only get to leave Goldman once. And I don't think they meant we won't take you back. I just mean you're most marketable when you're leaving such a wonderful place.
Yeah.
Which annoyingly might actually have been true at the time. So when arrogance is true, it kind of pisses you off. But I remember that phrase. So I ended up at Goldman Sachs gradually. I'm always reminded of that whole, how do you go bankrupt first slowly and then suddenly?
Yeah.
I took a summer away from the PhD program to work there just for a summer. I had 2 friends. One was a Wharton professor, and one was actually my best friend from college who worked together at Goldman Sachs. So they were like, why don't you come for the summer? Then they said, why don't you come for a year? And I spent a year actually in fixed income, writing my dissertation at night on quantitative, what we now call, again, we didn't call it that back then, quantitative equities.
Okay.
While trading fixed income during the day was a very weird life. You got to be about 26 to have the energy to work a Goldman Sachs day and then go home and work on your
lots of coffee.
Yeah. A little less than 10 years later, my wife and I had 2 sets of twins, 18 months apart.
Uh-huh.
And I always say that was a very similar stress level. Full-time AQR plus 4 babies at home was similar to full-time Goldman Sachs and writing a dissertation. Yes. Different nocturnal activity. But aside from that, very, very, very similar stress level. But then I just got lucky again. I was lucky to be at Chicago when Fama and French were doing that work. About the end of my year, I was actually struggling. Do I like Goldman Sachs more? Do I want to go on the academic job market? Eugene Fama and Ken French were putting pressure on me in a nice complimentary way to go on the academic job market. They wanted me to do that. And I was divided. It was fun at Goldman, but I was trading. That didn't feel like what I was supposed to do long term. I think I was okay at it, but comparative advantage says I'm not using any of these PhD skills. And then Goldman ended up, and even this is a lucky story, offering me a job to start a new group, a quant group. Mm-hmm. And I got that job, oddly enough, I think because of PIMCO, the manager, the West Coast, huge, famous, mostly for fixed income, but they do a lot of other good things. They had read my first published paper in the Journal of Portfolio Management.
What was it about?
Oh, that had a great title. Option-adjusted spreads and a steep yield curve. I am still waiting for the TV movie.
Usually your titles have gotten better over the years.
Well, there's a story maybe we'll get to there that it wasn't until the dot-com bubble and a near-death professional experience where I started writing a little more off the run and with a little more personality. Up till that point, I wrote kind of like everyone else, and I still do occasionally. In the Journal of Finance, they won't let you have personality.
Right.
But in the Journal of Portfolio Management, gives you a little more flexibility.
Yeah.
Financial Analyst Journal even gives you a little bit.
Yeah, it does.
But so they liked a paper of mine, invited me to talk to them, ended up offering me a job to start a cross-asset class quant group. By total coincidence, Goldman Sachs was looking to start such a group, and annoyingly and insultingly had not yet thought of me for this. They were actually interviewing outside people. There's even more ironic luck here. I believe the reason, certainly Goldman Sachs, I'm less sure about PIMCO, even wanted a group like this, was the then astounding success of the firm Long-Term Capital. This was 1994.
Yes, that's right.
No, excuse me. It was like 93 maybe.
1994. I had just arrived at the Ford Foundation, and I believe it just met you.
Okay.
Yeah.
That's how I remember 94, the year I met Larry. Not kidding. I do remember meeting you.
No, you're not.
I do remember meeting you, but
what year did you meet your wife?
I met my wife. I probably met her in 95, and we started. Not probably. I do. We started dating in 96.
So that's what you should remember, not me.
Actually, 94, I mostly remember for the New York Rangers winning the Stanley Cup, but that's a different story.
Oh, okay.
And then the next year I met my wife, which was even better. And that's my story, and I'm sticking to it.
Oh.
But Long-Term Capital I don't think no knock on them, but I don't think the people at Goldman Sachs Asset Management really had a clue what LTCM did. I think this idea that we could marry academics with Wall Street and create something great was just a general concept.
It was just right. It was a theme,
and
they
so
didn't know what LTCM was actually doing, or they would have traded against it and run them out of the business.
But we want one was the idea.
But we want one. Yeah.
And I was quite honest with Goldman. I said, "Look, I'm debating between staying here, going back, and being a professor. And now I have this offer from PIMCO to start a quant group that's actually quite attractive because it sounds like I can do the same intellectual stuff I would do as a professor and make more money." Anyone who says it didn't occur to them that going to a PIMCO or a Goldman Sachs might pay more than being a professor is probably not telling the full and honest truth. And Goldman basically, in all honesty, they did kind of oh, you're here. You should do this group here. And for that reason, that it was a marriage of what I wanted to do and being able to do it at Goldman Sachs, I decided to stay. I remember telling Eugene Fama that I was going to stay at Goldman Sachs and start this group. And his only response was, "Why do you want to go be a salesman?" Gene was not pro anything but academia. As a group, as a rule. I will say, and I admire it. It's not a put down. Through Dimensional, he might have done some selling of his own over the years. So I'm not sure that's a totally fair criticism.
I'd say he was waiting for somebody to make him an offer he couldn't refuse.
He did fine. Though for maybe 15 years after that, mutual friends would tell me something like, "Gene's pretty mad you didn't go on the academic job market," for a long time afterwards. And I'd always panic a little bit because I love Gene and be like, "Oh, is he really mad at me?" And friends would always say, no, he's not really mad. And I like to say Gene trained me to be too good of an empiricist to believe that he wasn't mad at me when 15 people started out saying that and tried to take it back. I think we're finally over it. But it took some years. It's complimentary, right? If people are mad at you for not coming and being a professor like them, it means they thought you'd be good at it. So I always took it as something nice, but it always made me a little sad. You don't get to do everything in life. I would have liked to do that too. My wife still thinks I'll one day go back and be a professor. I'm like, I think modern quantitative techniques have moved a little past me. Sorry to say.
Well, but I think when you're my age, you actually might decide that running a mega corporation is something that you've already been there and done that, and you might want to teach a few courses at that strange university south of downtown Chicago, and
well,
I'll come down there and listen to the classes.
Maybe wisdom will trump technical skills at that point.
Yeah.
And I'll actually be useful. Who knows? But so we started a quant group at Goldman Sachs with absolutely no mandate. Because remember, Goldman had no idea why they wanted this group. They just wanted it.
That's fine.
And their instincts ended up being right. So I'm not really putting them down. But it was funny. It was actually very nerve-wracking. The first few months of this group, we were quite nervous. We were a 4-person team. I was able to hire 3 other people. I hired 2 from the PhD program at the University of Chicago, which further did not endear me to the PhD program at the University of Chicago at the time.
Right.
We've made up over the years.
Who was that?
There was John Liu, my partner today, and super successful guy, Ross Stevens.
Oh, yeah.
So it was kind of,
both of them.
I don't get me wrong. I thought these 2 guys were awesome at the time, but, hiring what turned out to be an all-star team. Also, by the way, I named because he wasn't one of the guys from the University of Chicago, but Brian Hurst, who runs a fabulous little firm doing kind of pod shop stuff. He was the junior hire at the time. So I didn't know that. I accidentally hired what later became an all-star team. Hopefully not a total accident, but again, probably a little lucky. They were the people, 2 of the 3 were the people I knew. But we were running around as kind of, I jokingly call us door-to-door quants. Like we started this new group and it's like, does anyone need a quant? Does anyone need, we got kind of lucky. Again, I'm sorry, that's a theme. We got asked to help. There was a active traditional stock picking, concentrated, 20, 30 stock portfolio, active global stock picker run out of London that had a number of years where their stock selection within each country was fairly good, but they were always in the wrong countries. And this is, I feel a little bad about this because this was probably not even close to statistically valid. But in a corporation sense, it's like, oh, for 4 years, you've been bad at this. We'll let somebody else do it now. So they turned to us and they said, can you guys help them choose what countries to be in? And then they could pick the stocks. And we said, of course we could do that. Yeah. And then we went in a very small, dingy room and said, how are we going to do that?
For darts and a mat.
We didn't know. And we very, embarrassingly probably, I think it took us a few hours because it seems very obvious. But at the end of the day, we had studied what again we'd call quantitative stock selection. Back then it was narrow stuff, not what it is today. It was value, momentum, and maybe the size effect. Yeah. And we very quickly realized, hey, we could just aggregate these things and figure out, pick your favorite valuation metric, pick your favorite momentum measure. What's the valuation of the S&P versus the Nikkei versus the DAX? What's the price momentum of the 3? Would these ideas hold up in a statistical sense, not all the time, but would they hold up on average to pick countries? And again, some luck, they did. They certainly weren't arbitrages, but they had decent T statistics. We wrote a paper on this. We were aping academia with our titles at the time. I think the title of this one, I won't get it perfect, but was close to the parallels between the cross-section of country and individual stock returns.
So it's a good title, actually. I need to take a few seconds here off the record to say that we usually have 2 25-minute segments with a commercial in between. The commercial, I think, is just a few notes of music. However, just between you and me, we've gotten halfway through the first of 4 agenda items.
We're using up the first segment.
I would like to at some point get to not just the founding and evolution of AQR. Factor investing we're kind of covering, but to more what you're doing more recently.
All right, I'll move it faster.
Your research on the less efficient market hypothesis was suggested to me by one of your colleagues, Kevin, and or maybe it was you. And so I'm going to tell Michael at this point, let's resume. And with the second half, the music is over and we're back.
So we came up with this useful thing to help them choose countries. Very quickly after that, both we and Goldman realized we had models we had built for individual stocks from academia. We had country models. We extended that to bond and currency markets, again, just value and momentum using basic measures.
Okay.
And we said, we could run money directly with these. And I'll make a long story short. Over the next, 4 years at Goldman, we ended up running about $7 billion across traditional beat the benchmark assets and quite aggressive market neutral hedge funds. And at some point in 1997, I got convinced, largely by my still co-founding partner at AQR, David Kabiller, we could do this by ourselves.
Yes.
And again, leaving Goldman Sachs is hard. They were quite good to me. I think we did pay them back with a lot of productive stuff that they kept going for many years. But I felt the loyalty. But ultimately, I decided that I and my colleagues wanted to run our own shop, and a group of 7 of us left to start AQR.
Yeah.
With much the same goal, to build a quant shop that would do both traditional and aggressive, market neutral, what you might call hedge fund investing. Now, I don't know if you want me to get into this, but we had an interesting start. We launched 1 month before the dot-com bubble of 99, 2000 took off.
Yeah, I did want you to get into that because at first it's a great story. And I think most of the people listening realize that we could, this is not a forecast, we could be 1 month before a bubble breaks again.
The wolf is always at the door.
Yeah.
Our first month of trading was August of 1998, which was the month Russia defaulted, and stocks were down globally like 20%. And we were up a little bit on our first month in a supposedly market neutral product. And so we were at the end of the month high-fiving. We were like, we made money in a 4-year bull market, and now we're up in a crash. Awesome. And one thing I've learned is never, ever high five in this business. There are market gods. They are listening, and they do punish hubris.
Yeah, they don't like
because no, the next 18 months were dreadful. The famous dot-com bubble took off, and value was destroyed. Momentum helped, but not enough. Even things, I don't even remember when these got added, if they were there at the time, but variables like quality didn't help because it wasn't quality stuff going through the roof. It was low quality, expensive stuff. There is traditional factor investing, much like regular old Graham and Dodd investing, has a lot of periods it could do well in. Value doesn't have to do particularly well. Other things can do well. Yeah. But a total freak out bubble tends to be a painful time. And then we went into...
what is that? Sorry, go on. Naman, sorry to
please
jump ahead this far. But although I think that the Magnificent Seven are great companies, I use all of their products except maybe NVIDIA. But I'm probably using it unconsciously when I ask Google or
yeah, you are.
I am. It still feels like 1999 to me.
Well,
what's going on? And how is AQR reacting?
A few things. First of all, 2019 and 20 were to a large extent very akin to 1999, 2000. The old history doesn't repeat, but it does rhyme.
Yeah.
This rhymed really closely. Repeat is too strong. It was, obviously different companies, a few subtle differences, but very, very similar. Spreads between cheap and expensive, measured with traditional valuation ratios, alone or adjusted for differences in profitability, say between companies, some way to normalize it. It hit a record high in March of 2000, the dot-com bubble. And the way we measure it exceeded that high by late 2020. I could blame COVID for that, but that would be cheap on my part. That would be misleading.
Yeah.
Prior to COVID, it was approaching tech bubble highs, which, to be frank, I never thought I'd see in my career again.
That every 20
you know,
years, I mean, what is that? Yeah.
50 years from now, maybe everyone forgets, but
Sure.
20 years from now, people like me and you are still around.
That's right.
We're still kicking, and we're even more senior than we were.
Have more
and
influence
we know how
on
that
it.
one
Right.
ended. We made a lot of money from that one because we stuck with it, and the round trip was great. So
Yeah,
how will the world do this again? So it was by pre-COVID, it was getting really nuts, and then COVID just kicked it into the stratosphere. The 6
Right.
months after COVID, you were only supposed to own Peloton and Tesla, and you're supposed to be short everything else, and that was not a good environment for anyone who cares about like fair prices. Since then, and here's where I got to be a little AQR specific, and I apologize for that.
Yeah, sure.
General forms of value, like the Russell value versus growth indices, at one or two good periods, but have continued to suffer as the Magnificent Seven have dominated.
Yeah.
Our forms of value have come back very strongly. We wrote a paper on this in 1995. We don't take an industry bet to the extent we can. We find apples to apples within industries works better for many of the quant factors than across industries. This is in some dispute in the quant world. We're on the side of don't take the industry bet. That has certainly helped in the last few years. Also, value has come back much more globally than in the U.S. The Magnificent Seven are obviously a U.S.-centric phenomenon.
Yeah.
And it has come back in the U.S., just not as much. So I don't see it as a total value debacle for the last 4 years since the peak in 2020, early, maybe 2021. I forget exactly when it.
Well, that's great because I haven't been looking that closely. All I do is
if you look at the major indices, it's been a total ongoing debacle.
Yeah.
The Magnificent Seven have dominated, and I don't think you want to go to a quant to get an opinion on 7 stocks. We want to be, long 750 and short 750. High conviction on the whole, very low conviction on each individual name. So I'm not a guy who'll pound the table about the Magnificent Seven. But I will tell you, even measured our way, the spread between cheap and expensive, and I will be over precise here because I looked at it this morning, is back to the 82nd percentile versus history.
100 being the value is super cheap and growth is super expensive.
Exactly. And at the peak of 2020 or 2021, I was jokingly referring to it as the 125th percentile.
Okay.
And I like that you smile because when I tell this joke to quants, they get it, that there's no 100th percentile. There's no 125th percentile. It's just a new 100th percentile. Sometimes I forget my audience, and I say that to people who, no knock on them, should not be expected to know that. And I'm like, oh, no one's laughing here.
Maybe we're just maybe I'm just certifying my status as a nerd.
Yeah.
But I think I did that in 8th grade.
Yeah.
Somebody says we're going to try 100%, 110%. I said, what the?
That was always dumb. The sports cliche.
Right.
As an ex-Fama student, even if I deviated from efficient marketing in my dissertation, I still feel bad using the word bubble. I think I use it more than Gene, but less than most of our world. I sometimes accuse our world of using the word bubble to mean something we think is kind of expensive. No, bubble should be reserved for, I cannot come up with any plausible assumptions that could justify these prices.
Right. Yeah. Didn't you write a book called Bubble Logic, though?
Yeah, back in the tech bubble. And I reprised it later on. I do think late 2020 and early 2000 qualified for the word bubble. And there I will differ with Gene. I don't think I could call it a bubble now. 82nd percentile is you're getting a little more than you normally get. But in our field, you see 80th percentile all the time, and sometimes it goes back to 100, sometimes it goes back to 50. I think it's probably a little bit better of a bet than it normally is, particularly on a medium-term horizon. But I would not say value is a screaming buy at this point. A lot of things are expensive, so a traditional factor that many think should be arbitraged away because it's known for so long, actually still trading at wider gaps than normal is nothing to sneeze at. But it's not an irrational bubble that I think it's just a matter of time. You will win if you stick with this, but it's a question of survival. That's the problem in bubbles.
Yeah.
I don't think it's at that point now.
Okay, well, that's great. Can you, I was cued in on this by one of your colleagues. Do you use machine learning or artificial intelligence? I actually prefer the term machine learning because it avoids deep philosophical discussions about what the word intelligence means.
Yeah,
it's a machine and it is learning.
I use them somewhat interchangeably, but you're right.
I'm sorry.
Once you say artificial intelligence, you want to talk about Turing tests and stuff like that.
And neurons and had the meaning of cognition, and her dog's conscious
and conscious. Yeah, exactly.
That they're conscious. Yes.
I'm not sure I'm conscious, let alone my dog. But ML. It has surprised me. 5 years ago, we had an effort underway to see if we can make ML useful to what we do.
Mm-hmm.
I was probably one of the more cynical people. We've always prided ourselves on a lot of economic theory and intuition, essentially serving as priors to keep us from overfitting data. Data gets a big weight too. The best prior in the world that didn't work for 50 years is not something we trade on. The CAPM is a pretty good story.
That's a pretty good prior.
It's a pretty good prior. Utter failure. You want Paul.
I say it wasn't exactly right. It's a starting point for every investigation that's ever been done after that point.
That's a great way to think about risk, and there's a lot of insight to it. But the security market line is just flat. It has been for a long, long time. So you want priors and you want data. Data without priors is way too subject to overfitting. ML, by its nature, you can still have priors. And one thing we do at AQR is one thing we think we do a little different on ML is a larger role for priors than some who do ML. But it is undeniably a move towards data from priors. I mean, if you're letting the machine learn, you're kind of saying, I'm going to give a little bit more weight to just data against the theory I believed in early on. It's allowed to do things I don't believe in. Yeah. Or at least I don't believe in as much. I joke that I probably slowed us down in ML by at least a year just by having some cynicism about it. I do think it's the role of the old man at the firm when people come along and go, it's an old new technology, we can do it all better. It's kind of your role to go, whoa, slow down.
Right.
But I do think it has surprised me on the upside. We use it to generate signals. We use it to weight factors, essentially. And as an unheralded thing, it's a tremendous productivity tool for just research.
Yeah.
Even I can write code when it starts me off by writing the first version of the code. That's probably untrue. I've actually not tried this. Last time I coded seriously was in C, and I don't mean C++. So I'm dating myself a bit. But ML for signal generation. For years, quants, and I'm sure you've seen this before, it did rudimentary work, for instance, on trying to gather signals from corporate statements, from text.
Yeah.
And it would count up keywords, increasing +1, decreasing -1. And you could have complex versions. They could be weighted versions of words. You could have phrases in there, but it was essentially lookup tables.
Yeah.
Anyone listening probably immediately sees the problem with that. If you give a +1 for increasing, but this time the phrase was massive embezzlement is increasing, then +1 was probably not very well chosen.
There's a deeper problem, which is that corporations would learn to game that pretty quickly.
That ML trained on a gigantic amount, and you really want. Obviously, ML is data hungry.
Yeah.
We use it for some small data problems, but then you need to rely on your priors more. The more data you have, the less you need to rely on your priors. Modern natural language processing, where you're training it on the text. This is horribly inaccurate. And the head of ML here at AQR, Brian Kelly of Yale, probably yell at me for this, but I always think of this as reverse ChatGPT. ChatGPT, you put a query in, you get text out. Now we're looking at text and we're trying to get some summary of the text. Is this good or bad news?
Right.
It's just way better than word counts. Language is inherently fairly nonlinear. Whether increasing is a positive is not necessarily just a function of the prior 3 words. It can be in context of the whole thing. It's not perfect. Obviously, someone could say something brand new. And actually, a fear we have is exactly what you said, corporations adapting to what people like us are doing and changing what they say. But it's a lot harder for them to do that with natural language processing or NLP than it is with simple word counts. All right? If you know the quants are counting the word increasing, you just say increasing a lot. If you have a much subtler version, you are hopefully no alpha lasts forever, but you're hopefully a few more steps in the curve. So we're using it for that. We're using it to combine factors. Traditionally, this was my job and the other senior people at AQR. We have the set of factors and families of factors, and then within that, many ways to measure a concept like low risk, like profitability, like value, like momentum. And then we chose the weights at the top with some kind of prior belief on what should work. It turns out that even simple, they're not even that simple, but even Bayesian techniques, which we were moving to before ML, of allowing the system to choose the weights amongst factors we believe in. This is important. This is where you kind of constrain ML a little bit, or constraining Bayesian. In some cases, we'll time factors and allow shorting, but in most places, you're only allowed to go long a factor you believe in. That dramatically constrains the set that it can data mine over. Turns out both simple Bayesian and modern ML techniques are annoyingly better than me at choosing those weights. No one loves when their job is taken by a computer. So yeah, it's affecting everything we do, and we keep finding new uses for it. We're now using it to do basic value investing, but in a far more flexible fashion where the measures can vary by industry and other ways to relate one stock to another, where the measures can have nonlinear forms to them. ML excels at that. And as long as you penalize it enough for overfitting and have a very broad set of models to average over, I didn't get it 5 years ago. I do think it's making us better at what we do. It's kind of fun.
That's great. I'm even older than you, and I'm more of a skeptic.
We're rounding to the same age at this point. You used to be older than me. Well, I'm asymptoting to Larry.
Yeah, we're all asymptoting to the same thing.
Oh,
but at different rates and different starting points. I just had my 70th birthday, so I'm asymptoting away from you briefly here.
Okay, that's a biggie. I'm going to be 60
Have
soon.
You turned 60?
I'm a little behind. No, not yet. Soon.
Okay. Well, let me know.
Though as Indiana Jones says, it's not the years, it's the mileage.
Right, it is. We have about 10 minutes. I read or tried to read a fascinating paper that you wrote, I believe, with colleagues, called The Less Efficient Market Hypothesis. Can you tell me what is it? What's the hypothesis? Sure. And why would the market be less efficient under current conditions than it was during the period when the efficient market hypothesis was at its peak?
Sure. I knew it would be counterintuitive. That was the fun. You said my titles have gotten better over the years. This is a little bit more of a modern Cliff title, a little pithy.
Well, what do you think was your best title ever?
I like Bubble Logic.
I do too.
It was, that I never published that because I tried to make a book out of it back in the tech bubble.
Right.
And Bubble came down too fast. I kept revising it.
And then you wrote Bubble Logic.
Yeah, years later. But that was for you guys at a review kind of thing. But it turned out a book was not the right way to forecast a bubble because a book is too slow. Yeah. And if the bubble comes down, you're always, writing a book saying, hey, if you had read this 3 years ago, I would have called the bubble. Not that exciting. Yeah. So I should have made that a short article. That was my favorite. But this one started from the simple observation that dot-com or tech bubble in the late 90s that had not been seen in 50 years of objective data, that then got exceeded by 2020, 2021, led me to start asking why. Why? If I believe these are bubbles, and I don't overuse that word, but I think those, maybe the Japanese stock market in the late 80s, are the only stock market ones I will say I experienced even at the beginning of my career. So I'm not someone always screaming bubble, but I think those two happened and at unprecedented levels that we had not seen. What changed? And I started thinking this idea that we get more efficient over time is a natural one. And we're thinking mostly about technology. March towards more efficiency. Data is ubiquitously and instantly available. How can we be less efficient? And I decided, and I should tell you, this piece is going to be in the 50th anniversary to the Journal of Portfolio Management. It's a lot of opinion. I say that very upfront. It's very hard to prove market efficiency itself, let alone 20-year changes in it. But my strong opinion is that technological change like we've had makes things faster, but it doesn't really make us process information better. A lot of the did it take 10 minutes for some information to get into security prices at the beginning of my career? That now takes 10 nanoseconds with an HFT whose computer is sitting next to the exchange and co-locating? Yeah, maybe. But for a medium-term strategy, valuations that were relevant to predicting 1 to 5 year horizons, 10 minutes versus 10 nanoseconds is deeply irrelevant.
Yeah,
that matters to the HFTs. If you have a 20-second latency and everyone else has a 10, you're going to lose money with great certainty. So they care, but we don't care. And I started thinking, I have a few other theories. The role of the rise of passive is certainly a possibility, though that's much less obvious than people think. I think some people just say
it's obvious. I'm fighting the other side. I'm saying, come on, if passive is worse than Marxism, according to somebody at Alliance.
I wrote a response to that.
Oh, good.
It was.
I'm sure it was trenchant. Show me the evidence.
Yeah.
Because if the market's so inefficient, it ought to be easy to earn alpha, and it's almost impossible.
Well, I will agree with most of that. I don't think easy to earn alpha is necessarily the same thing as an inefficient market. The sharp arithmetic, and I mean Bill Sharp, although it is sharp arithmetic also, that the average never beats the average, is tyrannical and ironclad. So I don't think
ironclad, and that means that if the market is completely inefficient, the big positive alphas will be canceled out by big negative alphas.
So you have to argue why you will be on the positive side. I do think a less efficient market can lead to some subset of investors, which I have the temerity to hope to belong to be more reliably in that. So I don't think it's quite the same, but mostly I agree. I think those who, the passive is the devil community, are always pointing to like the Magnificent Seven, and passive is so distortive. And I'm always like, passive is proportional to market cap. It's not really distortive. I don't know how you get that.
Yeah, I wrote a paper, not really a paper, but a note on that called Index Fund Silliness, why passive investing distorts nothing.
Well, I could be convinced there's some effect, but I've not seen a logical argument other than people just pointing to these two things. Plus, when I quoted you earlier, the spreads between cheap and expensive, you can throw out the major big caps. They're still gigantic versus history at the peak and still wide versus history. So it's just not that. Where I give a little possible credence to passive mattering is we all know one thing we can't have, 100% passive. Jack Bogle, I had him on an AQR podcast at one point. We used to have a podcast because legally in America, everyone must have a podcast at this point, at some point in their life.
I will have a podcast.
This is your podcast.
This is my podcast for now, but I have another life where I write about larger issues like the environment and
Oh yeah, Larry writes great stuff. By the way, your books on advancement, greener, etc. It's just true. The world has gotten better, not worse. And Larry's one of the few people who will tell you about that. But with that brief commercial, for Larry, even Jack Bogle, because he was a very honest guy, admitted the obvious. 100% of us can't be passive. Somebody has to put the work in. Funny, on our podcast, I said, so what percentage can be passive, Jack? And he said 75%. And I said, that's fascinating. Where'd you get it? And he goes, I made it up. And when you're Jack Bogle and you're 85, you could do that. The only credence I'll give this camp is, given we know that world is broken, prices make no sense. No, there's nobody doing it. It's unlikely all of the broken happens between 99.9% and 100% passive.
No, it's somewhere else.
Some loss of efficiency from the amount of passive we have, but it's very hard to put your finger on. I thought I was giving the people who hate passive at least a little of what they argue for, and they all hated me for this piece because I didn't make it the number one reason. So I'll put that in the mix. But my preferred reason, both because I think it's a bigger effect and because it's counterintuitive, is we started out saying a lot of people would assume technology makes things more efficient. I'm going to argue a lot of technology has made us dumber. And as Exhibit A, I will point to our politics. Has the electronic media, the cable news that we all get tailored to ourselves now, has social media, for God's sakes, made us collectively smarter in our political arena than we would have been? And I don't think there are many Americans who will argue, a lot of them will say it's the other side's fault, but I don't think there are many Americans who will say, yeah, we're much wiser than we used to be. Politics is obviously a voting mechanism. So are markets. Markets are a voting mechanism. People vote with their dollars, and more dollars with X opinion beats fewer dollars with X opinion. At least the price is largely in their direction until markets clear. So considering these forces are tremendously at work in markets, the dot-com bubble coincided with the rise of so-called message boards, kind of proto-social media where everyone was chatting about stocks, and it was very cult-like. And I spent some time on these message boards as an observer. My compliance area would sadly not let me post at that point. It took many years for me to get senior enough to override my compliance area and tweet away about these things. But if anything, markets rely on the famous wisdom of crowds, the idea that we're collectively smarter than we are individually. But a crowd is only wise if it's relatively independent. Has there ever been a vehicle more effective for turning a wise crowd into a potentially dangerous mob than social media? I know I sound like
back a little, Cliff.
Please. I know I'm just an old man whining about the kids and their crazy social media right now.
Yeah, I read a much wider variety of opinion and research and than I did when let's say in the 80s or 90s, the New Republic gave me news from the left. National Review gave me news from the right. And I had to process those 2 points of view, which had already been vetted by the respective editors of those two magazines to make sure that they didn't stray too far from what the editor believed. And now I can find anything I want, and they do. I'm naturally curious, and I don't just read stuff that I agree with. I'm not sure that social media has made me dumber. Old age and crankiness has made me dumber, but that's irrelevant. But
all of this, the social media and the ubiquity of information that's available just in general electronically, has the potential to make us smarter. If one forces themselves to watch different sources on TV, to read different things. I don't, no one might believe me, but I sit in my office and I rather equally switch off between CNBC, CNN, MSNBC, and Fox News.
Yeah.
And believe it or not, they do have somewhat of a different perspective on things. I
Yeah, but
read
if you average them all together, it's not bad.
Yeah. I read the New York Times every day, which some of my libertarian friends, which I can still consider myself one of,
Yeah.
not the party, not the small L libertarian, not the big L. Some of them have gone absolutely mad. But the small L libertarians are like, why do you torture yourself with that? And I'm like, because I want to know what they're saying. But I think you are just a more generous soul than I am. You are saying what I do, I'm not better than other people, so they must be doing what I do. And I think there's a tremendous amount of people that have one source on all day that have gotten rid of, bless you. I've never said bless you over a podcast before. That was kind of fun. Gesundheit, even more fun, better word.
More fun,
yeah. I think the number of Americans and people globally, not just our country, who are getting all their news from confirmation bias, from algorithms that funnel them towards more agreeing and more extreme sources. We're discovering I'm much more cynical that is the norm, and you are the exception to that norm. And if it's true, and I'm very humble in the piece, which is not, as you know, my characteristic starting point. I say it's opinion. It is opinion that is colored by personal opinion, living through and net prospering, but having near-death experiences in two different bubbles may have pushed me to believe something. I know that. But do I believe that the average and marginal investor is more in the direction of what I'm describing than in the Larry Siegel direction? Yes. And since markets are just voting mechanisms, if that's true, it's tautological that it will be less efficient because more people have got the ultimate. If I were to cheat, not fair to cite the most extreme outlier as your evidence, but just for fun, I will cite the meme stocks in the U.S. As the ultimate example of social media-driven insanity. Donald Trump media, with his rise in the betting markets, is back to worth over $11 billion. You say, I'm not supposed to give investment advice. I'll be a compliance guy. Nobody take this as investment advice. With that said, I promise you that company will never make a nickel. And it's worth $11 billion. That's a pure meme stock phenomenon. And there have been others. I made the mistake of mentioning we were short a meme stock on CNBC once, which is not something you want to do. I became public enemy.
Did you get
I became public enemy number 3 to the meme stock crowd. If you're curious, number 1 is Ken Griffin, and number 2 was Gary Gensler. Two people they think are in bed together. Having met both men, there are no two people on earth, I think, less likely to be in bed together than those two. But it is a dark, conspiracy-driven world. And I do not claim everything is like that. But I do claim life is a continuum. And they are the extreme example of something that I do believe has made markets not grossly inefficient. I say in the same piece that I have no better alternative than markets. My view of markets is the same as Churchill's view of democracy. It is the worst system ever tried, except every other one that's ever been tried. I do think, though, and there's hope we adapt to it and we go back to being rational. Often with new technologies, we don't fully adapt for a while. And then eventually we kind of endogenize the craziness and understand it. But I think we're still at a stage where it's making us worse in any collective decision we have to make. With politics being the more important one, even with this being my career, I don't put this at an even level with politics. But with markets maybe being a not too distant second. So I am a believer they've gotten less efficient. I think I know why, with the humbleness that this is still one increasingly older man's opinion about the new tech. I'm harumphing at new technology. I know that.
Well, on that very helpful and I believe positive note, I would like to thank you, Cliff Asness, for spending all this time with us, and the Research Foundation and our listeners, thank you.
For more information, please visit rpc.cfainstitute.com. www.quantitative.org/research-foundation.